What'll happen is with oil prices, it'll happen with corn prices, whatever. You're going to wake up one morning and these things will be down 40%. And you're like, what happened? And you go look at the newspapers like, war is over in Ukraine. And as soon as that headline hits, commodity prices are going to dump because everybody's like, well, what was driving the prices higher is over. I'm getting out now. And remember, the way commodity markets work, it's always the first guy that raises his hand and says, "Mouse like the tulip bubble, I'm out," and then everybody else is out too. And then you're standing there looking around going, well, wait, when's my turn to get out? It's going to be too late at that point.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap featuring my good friend Lance Roberts. Lance, how you doing, buddy?
Hey man, I'm here. It's Friday. We survived another week. I don't know exactly how, but here we are.
Yeah. Well, they say some weeks you get the bear, some weeks the bear gets you. This week, the bear officially got the markets. Yeah. So today, like many days in the past 2 months, we opened green. Things looked pretty good for about the first 2 hours, and the wheels came off. We went down pretty hard, and during that process, we dropped below the official threshold to throw the S&P into bear market territory. Looks like the market managed to kind of eke its way back up to flat by the end of the day. But of course, we did puncture that technical milestone there. So how important is that, Lance?
It's not. And let me tell you why. So this idea of a 20% decline equals a bear market is complete hooey. So let's just throw that out the window. This is like saying a 20% advance makes a bull market. That's not the case either. What is the defining difference between a bull market and a bear market? And that is the trend in prices. Are markets trending positively over a long period of time, or are they trending negatively? And if you look at a chart of the S&P 500 right today and just go back to 2009, we are still well entrenched within a bullish trend. And so, yes, we're having a correction here, but a 20% decline is not necessarily a bear market unless you break the prevailing trend. Go back and look at the markets in 1998, 1999, 2000. You see that break over. You see a break of that uptrend in the markets. That was your classic definition of a bear market. 2008, exactly the same. Now, I will tell you that we have some very similar things going on right now, and I'm writing about this in our weekend newsletter, that there's some very similar patterns to what's happening in the markets today versus what happened in 2008. Now, we're not talking about a financial crisis. We're not talking about a Lehman bankruptcy. We're just simply talking about market action, right? Bearish action versus bullish action. Let me give you another good example of why 20% decline is not a bear market. Let's go back to 2020, March of 2020. We had a 35% decline in the market, and all that decline did was retest the uptrend from the 2009 lows. So again, we never broke the trend, and a bear market does not recover immediately and go right back to new highs, then add on another 50% advance following that. And people aren't rushing to get into the markets to speculate on the most bankrupt of companies. That's not what a bear market is. A bear market is when nobody wants to invest. And I'll tell you that there's an interesting thing going on right now that also suggests that this isn't a bear market. I've got too many people calling me right now going, I'm sitting on a bunch of cash. I'm just waiting to put it into the market. That is not what a bear market does to people. When you're in a bear market, and Adam, you'll remember this from 2008, nobody wanted to put money into the markets in 2009. In fact, in February of 2009, I was running another advisory firm at the time, and I wrote an article in March of, so let me kind of lay out the history for you real quick so we have a timeline here. In December of 2007, I wrote an article saying we are about to be in, or we are in, the worst recession since the Great Depression. Now, nobody believed me at the time. And then in December of 2008, the National Bureau of Economic Research comes out and says, oh, the recession started in December of 2007, right when I wrote the article. Well, in February of 2009, I wrote another article. I said, now is the time to start buying stocks. 8 reasons to buy stocks now. We lost about $50 million worth of clients at that time because they're like, are you nuts? This market's going to zero. Don't you know what's going on in the world? The world has just ended. The last thing you want to do is buy stocks. I was 8 days early with that article, but March the 9th was the bottom. So the point here is that there are too many people right now wanting to buy this market. There's too many people still looking back to March of 2020 going, man, this is my opportunity. I missed that March 2020 rally, that 120% advance. I missed that. I got to get in this time. I don't want to miss it this time around. That is not a bear market. So, and here's the point, Adam, I'm not arguing with you over the fact that the market's down 20%. That's a terrible thing. I'm not saying that, but I want to get people to stop this whole thing of measuring markets and saying 20% decline is a bear market, some advance is a bull market. Well, what's the definition of a bull market? There isn't one. It's just its prices are going up. It's a bull market. And if markets rallied 5% next week, I guarantee you Jim Cramer will be on the air going, oh, we're back in a bull market. The bear market's over. This is the problem with these, tags that we put on this stuff. And our job as investors, and this is our whole methodology with how we manage money for clients. We're not bullish or bearish. I don't care what the market's doing in terms of a tag, whether it's bull or bear or snake or rabbit or monkey or whatever. What I want to know is, are prices going up or are prices going down? Where can I make money for my clients, and where can I protect assets when I need to? And look, we took a ton of grief earlier this year for owning bonds. Those have been our best friend this past week, because that non-correlation of risk assets are now coming back to the function that I don't want to be in stocks. I want safety. Where do I go in safety? I want bonds. So, let's focus on what markets are doing rather than trying to label these things. Sorry, that's my rant for the day.
Wow. Yeah. You kind of pre-ranted on this one. Don't worry. I think I've got a few other things for you to react to.
No,
don't lose all your anger
you
yet.
You get one rant a week and that's it. So.
All right. You said so many great things there. Let me just underscore, because I did an interview earlier this week, actually a really good interview, got a lot of great feedback. I'll put a link to it here, with Ted Oakley of Oxbow Advisors, a fellow Texan there, Lance, and a very seasoned guy. I think he's even got a few years on you. And he basically said the exact same thing. He just said, this sentiment wise is nowhere near a bear market for the reasons you mentioned. He said, when you're really in a real bear market, stocks are just radioactive to investors. Mm-hmm. People just can't imagine them ever going up again. You're in the get me the heck out stage, right? Yeah. And as you're saying here, there's still a lot of longs holding on with hope. And there's a lot of people, with some cash on the sidelines saying, okay, is this about to be my chance to get back in and ride the bounce, right? Yeah. Not that a bounce may not happen. I'm going to ask you about that in just a minute. Sure. But it does seem to be far too sanguine still at this point to be considered sentiment-wise, a bottoming out right in the markets. Yeah. Okay, so I want to just give you a few more data points, and then we'll get into sort of where you think things are headed from here. You mentioned some similarities you're going to be writing about this weekend to the 2008 market. Here's one from 2001. Stocks have had 7 straight weeks of losses, as shown by this chart here, and it's the longest stretch since March 2001 during the dot-com bust. All right, so I want to take this chart. I want to contrast it with this next one, or compare it with this next one, which is in a tweet from Sven Henrik, the technical analyst that we've talked about before. He says that the weekly RSI for the NDX, which is the big tech stocks, is now lower than it was during the COVID crash, lowest since the global financial crisis. Only the global financial crisis and 2000 tech crash, going into recession, had lower readings than where we are right now.
That's right.
So I kind of look at those and say, okay, definitely cause for concern. And it's sort of feeling a little binary-ish, like, hey, this is data telling us that we're going into a world of pain still from here, or man, things are so extreme, like we were talking about last week with the elastic band and whatnot, that there's going to have to be some sort of reflexive snapback at some point here because things are so damn stretched. What are you thinking?
Well, so 2 things. One, and so that chart you're talking about where you're down 7 straight weeks, during the 2001 and 2 bear market, that was a pretty long drawn out bear market. It was roughly 18, 20 months. And during that decline, you had multiple 10% rallies, and they didn't get you back to previous highs, and they didn't get you back to where the highs were from the previous decline. But there were several counter trend rallies that gave you an opportunity to reduce risk at a better level. We had the same thing occur in 2008, except for in 2008, that September Lehman moment where when Lehman filed for bankruptcy, it froze the credit market, and you had a plunge that lasted about 4 or 5 days of just straight down market because, again, markets ceased to function on the credit side of the spectrum. We don't have that today. Michael Leibowitz, my partner, and I were doing some work today, and he's building an index for us for our SimpleVisor platform that is looking at credit risk. And right now, we don't have really anything in terms of credit risk going on in the market. Spreads are not blowing out. They've come up here a little bit, but they're nowhere near levels that are a concern that there's something financially breaking in the markets. And that's kind of a good thing, bad thing. The first thing is it says that, hey, you know what? There's not a lot of risk to the market. There's not panic going on. And you take a look at volatility as another good example here. Take a look at the volatility index. And what you see there is you see it actually over the last couple of weeks, we've actually had lower highs in volatility. We're not spiking to the moon in volatility, which is what you'd expect if this was a real panic-driven bear market. And this is, and yes, there's a tremendous number of headlines out right now. There's like 8,200 articles. If you Google bear market, there's like 8,200 articles. It's like near a record of the number of articles of people writing, oh, it's a bear market. But you don't have that real kind of panic in the market. This has actually been, it ain't been fun, right? I mean, this market has not been fun this year. Everybody and their dog want to go back to 2021. That was a great market to be in. It just went up every day, buy whatever you want. This has not been a fun market, but it's been a very orderly unwinding of that speculative excess that we had in the previous market. Again, there's not a lot of credit stress. Markets are really doing a lot of the yeoman's work for the Federal Reserve at this point. Inflation has likely peaked. And if we get any type of good news at all, if we see PCE and CPI next month take a pretty sharp break for any reason at all, because we are starting to see, what's happening on the consumption side of this ledger, any type of good news is going to probably have a pretty sharp reflexive rally in the market because there is so much negative sentiment. The number of stock, somebody sent me a chart today, and I'll have to see if I can find it, but of the number of stocks that are trading above lows on the NASDAQ, and it's like one of the lowest levels ever. It's just everywhere you look. We have a technical composite that we put out in our newsletter every weekend. So I'll run it in the morning, and I'll put it in our weekly newsletter. But that was at 12 last week. I guarantee you it's going to be in the 9 region. And the last time it was at 9 was during March of 2020 at the lows. So my point is that, these, the things that you just brought up, the things that I'm talking about, there's just indicator after indicator after indicator that this market is severely stretched to the downside. And there's buying that's going on into the markets. And Friday was a really good example of that. Yes, Friday opened up, we sold off, and then we rallied back to even at the end of the day. Well, that end of the day action, that's institutions. Retail plays in the front end, institutions play in the back end. So, this is, so what that's telling us, and again, also remember, Friday was options expiration. So
I was going to ask about that.
Yeah.
It was a pretty big one, right? Almost $2 trillion worth of OpEx. What kind of influence did that have?
A tremendous amount. That was the sell-off, and that was the rally at the end of the day, because that's where all these institutions have to roll over all these options and then reposition. So remember whenever, just as a function, if you don't understand options and those type of things, it's okay. We're not going to have a big, we'll do a class on it someday. But basically, when there's an option contract, it's a contract. And so Adam wants to be long Apple and I want to sell Apple. Okay. So Adam is going to buy a call. It's a contract between me and Adam that says, if Apple goes up, I agree to sell him my shares at some price in the future. There's a specific price that's set in that contract. Don't worry about all the nuances. It's not important. But what happens is, in order to create that contract between me and Adam, a market maker has to buy the shares and write the contract against those shares, because if he has to deliver, that contract's got to be there. So when these contracts have to unwind and get rewritten and all this, there's buying and selling that are going on to deal with these options expirations and the rewriting for the next contract leg. So, that creates, and particularly when you have a big options expiration day like you had, yesterday, that creates a lot of volatility in markets. But the important thing is that there was a lot of buying at the end of the day as investors are having to position on the long side of the markets. And that was an encouraging bit of attitude, because we actually held that low from the last decline. So we had a decline, we had a little rally, and then we kind of broke that low. Well, we rallied back and held that support that this market's been trying to hold for the last couple of days. So from a technical perspective, the action ain't great, but there is certainly some signs. I'm watching money flows come into the market. Those are starting to pick up here, be more positive. We're watching, spreads on different instruments that are becoming more positive. Again, volatility has been coming down, not going up. That's positive. There's certainly some things here on a technical basis that suggest being a little bit cautious about panic selling at this point. I know, Adam, you and I have been talking about a reflexive rally. It hasn't come. And, right now, you have been better off selling 2 weeks ago, right? No arguing that fact, but that's the way the markets work sometimes. They don't always do exactly what you expect them to do. But, what the market's doing right now, I have this sneaking suspicion that, you're going to sell and this market's going to rally. I just think the market's waiting, for, me to sell. And then once I sell, we'll go back up. So,
it always is.
Yeah, exactly. But, I just want, all I'm saying is just be real careful here. I still am saying that, look, you need to raise cash. You need to, reposition your portfolio in any rally that you're getting into, because we'll talk about this in a second, but we are either in or about to be in a recession. And there's a lot of indicators that are telling us that right now.
Yeah. Hey, can I put words in your mouth and you can tell me if they feel right or not? Is it a good time to get rid of the things that you don't feel good about, and then be positioned for, if there is a bounce, to lighten up on the rest?
If I was, well, this is what I am doing, so I won't say if I was doing it. What I'm doing right now is I'm buying stuff that I want to own on the value side of the sector, because if this market is going to continue to break down here, defensive positions will do well. And a lot of these defensive positions have really been beaten up lately. So if we start to get a rally, we should see those positions do a little better. So what we're looking for here is a rally to get rid of the stuff that we don't like. And this is stuff that we've already reduced a lot. We have fractional holdings of long positions that, we're kind of working with right now. The rest of those will be eliminated on a rally. But while we're having that rally, we've got enough of this value defensive side of the portfolio that'll help lift the portfolio and let the portfolio grow a bit. And then we'll reduce those positions we don't want, add our short hedges, or other market hedges, whatever we want at that point, depending on what the markets are doing, and then prepare for whatever happens next.
Okay. And that's helpful. And that makes sense. I guess part of the spirit of my question was, there's no guarantee we're going to get a bounce. So if given that you just said, and I agree, hey, we're headed for a recession at some point here. If you've got stuff in your portfolio that you'd love to sell on a bounce, but you really don't feel very good about it, right? Should you take the opportunity now to lighten up on at least some of that, just in case we don't get that bounce?
Yeah, no, absolutely. Look, there's this funny thing. I got an email today as a good example, and the guy says, I'm 2/5 equity, 3/5 cash, and I just can't stand the market. It's killing me. I'm like, well, if you're 2/5 equity, 3/5 cash, you're not down very much this year, right? But I was like, look, the answer to that is really simple. Sell everything, go to cash. The problem with being all in cash, as we've talked about before, is the getting back in part, right? That's the psychologically hard part. But there's nothing wrong. If you just don't like this volatility, don't like the market, there's nothing that says you can't just sell everything and go to cash. And then when the market looks like it's performing better, buy your stuff back. People have this really weird kind of philosophy, and I've seen it for the last 30 years. They're like, if I sell ExxonMobil, I'm excluded from the ExxonMobil club. I'm never allowed to buy it back.
Right. It's like you buy it back the next minute.
Exactly. But, they're like, well, I can't buy it back. I sold it. It's okay, right? If you're a Tesla bull and that stock's been getting killed here lately, you can sell your Tesla. You can always buy it back at a lower price or a higher price when the thing starts performing better. So look, if you're up at night look, your health is the most important thing, right? Money's fine, but if your health is crappy, the money's not going to do anything but go to healthcare bills. So look, if you're not sleeping at night, you're not eating right, you're all stressed out, you're not enjoying your life, what's the point of investing, right? Just put it in cash, go enjoy your life, do what you do that earns your income, which is your job. Be happy with your kids, your family, your loved one. And then once things calm down and you feel better about things, put your money back to work. There's nothing wrong with that at all.
All right, great. All right, look, I want to move on to bonds in a second, but I want to ask one last question about the options expiration. And the perception I have as an individual retail investor, and this is certainly sort of the wrap the options expiration week each month has for amongst small fries, is that's when you can kind of expect the market makers to try to, finagle prices if they can to try to force as many bag holders on the retail side.
Yep.
Right. And I see you sort of smiling as I'm saying this. How much truth is there to that?
A lot. Look, this, it's interesting. You remember back when we had Wall Street bets that was running wild and rampant. It's like, hey, us retail traders, we're going to go get Wall Street, right? Finally,
talk about it like it's ancient history. It was like a year ago.
I know, right? The little guy's going to win. No, you're not going to win against Wall Street. Wall Street's the house, right? The market's the casino. You're the gambler. You're going to lose every single time. Yes, absolutely. When you're on Robinhood and trading your shares and you're getting to trade for free, isn't it great? No, you're not. Those orders are being sold off. They're being front run by some big hedge fund in front of you. They're making the spread on the pickup. And among others. But yeah, Citadel's the big one. But yeah, that's why these companies make billions upon billions upon billions of dollars. There is no such thing as free trading. You are not getting free trades. You are not getting free execution. You're not getting free anything. Everything is costing you. It's just costing you in different forms, either through pricing, through structure, whatever it is. You're paying for it in a lot of cases. And look, I've talked about this before. I've written articles about this. The best thing that we could do for the market is get rid of all these, these strategies and these companies that are, front running trades and clearing markets, and go back to commission trading. Yeah, you know what? It sucks paying a commission, but two things happen when you pay a commission. One, it's transparent what you're paying for it. And two, it slows down trading, which makes you a better investor long-term. Because when you can trade for free, you just trade your brains out and you make the worst possible decisions. When you've got to factor in a trade cost of 25 or 30 bucks, yeah, it sounds terrible, but guess what you do? You slow down that trading action. You wind up making a lot more money over time. And that's provable. We can go back and look at history and look at where we had quarter basis point spreads on stocks and stock commissions, and investors were a lot more profitable and they held positions longer than they do today.
Yeah, I hate to make an argument in favor of commissions, just because I hated them back in the days, right?
Well, so did I. Now I see the evils of free.
Yeah, well, exactly. And to make the analogy maybe a little bit more real for people, it's as Lance is saying, look, in the markets, the odds are favored towards the big guys, right? No big surprise. Just like if you go to a casino, the odds favor the house, right? Now you can go in and you can be really patient and you can wait to place your bet when the odds are, really in your favor because you got a great hand, right? But the more hands you play at the casino when you're there, the more you are bringing your total return in line with the average odds, which are in the house's favor, right? Yep. It sounds like, Lance, you're saying the same thing's true in trading.
Yeah, absolutely it is. And this is always the case. This is why we always talk about playing possibilities versus probabilities. Always play to probabilities, because your probabilities are going to work out more often than your possibilities.
It's a great way to say it.
Yeah, and the thing is it's exactly to your point. Look, nobody that's listening to this video is an investor. Not one of us. We're all speculators, and because all we're doing is buying pieces of paper at one price, hoping to sell them at another. Warren Buffett's an investor. When he buys a company, he goes in, looks at the guy at the head of the table and says, "You're in my chair, get out," and starts running the company, right? He puts his guys in there and they start running a direction. They report to him. That's investing. That's truly investing, because you can control the outcome of a company based on your decisions. You don't do that with your 1/100th of a millionth of a percent ownership in Apple, right? So, it's great that you own it, but we're all speculating on higher prices. So we have to treat our portfolios just like we would treat a poker hand. And that's why I use so many poker analogies, because it's such a close similarity about risk sizing, placing bets. How do you manage your risk? When do you take your money off the table? When do you walk away? Those type of things, because that very function of poker or craps or whatever you like to play, it all feeds into the stock market.
Well, what's interesting is, the modern study of statistics was born out of games of chance. Mm-hmm. So all of the statistics that we use in investing, started centuries ago as people were trying to calculate probabilities in games of chance. So it actually is, directly applicable. All right, so let's get back to bonds now. So you mentioned that we finally had a good week, at least for long-dated U.S. Treasuries. And we've talked about TLT a lot in this program. I know you felt a little bit bruised because that trade has been taking longer to play than you thought it would. And just to give you credit here, you've been making that as, well, I won't put words in your mouth, but my understanding was that was more in the near term for kind of this bounce that you were sort of expecting in the market. And that the bonds had been just so oversold. We talked about the number of standard deviations that they've been oversold. So we had a really stretched rubber band there. I think TLT went from like 114, the low of earlier this week, to like 1850, 1860.
Yeah, it was a nice week.
Yeah, nice week. So, I'm sure there are people that bought in earlier and are, higher price and hoping it's going to go higher from here. Do you feel like this is building some momentum, or do we have to sort of wait and see here?
No. Well, first of all, remember, let's go back to when we first started talking about this trade. This is a long trade, right? This is a long duration trade. This is 12 to 18 months for this to work out. So this little bounce here is great. What's important is that this is the first week that we've had in quite a while where there was a non-correlation between stocks and bonds.
Which is supposed to be there, which is
supposed to be there, but it hasn't been. And that's been very painful this year because stocks are declining, bonds are declining. You're just getting hit everywhere you turn around. But this week they actually played out very well. So even though stocks were under a lot of pressure this week, bonds were inking up, and that was really helping, the return of the portfolio. We're outperforming our benchmark now by like 700 basis points. So, and a lot of that was due to the fact we have a lot of cash and those bonds that were sitting in there and actually working very well this week. So, that's really kind of helping performance overall, keeping, trying to keep these accounts kind of stabilized. But two things that really came out this week in terms of bonds. So let's step back for just a moment, because I wanted to talk about a recession. Either we're in one now or about to be one. So back in 2008, in June, July, right around that area, the market was going through this topping pattern. We broke the neckline on the head and shoulders pattern, came down, tested a low, bounced back up to that neckline, failed, turned low, and broke a new low. Now, when we broke that low back in 2008, that's when we sold out of all of our equities in our portfolios. Interestingly enough, we are right on the verge of that again. We've completed a head and shoulders pattern with a descending neckline, rallied to it last week on that rally. Last week on that rally we had, rallied to it, turned around, completely broke down, retraced that whole advance that we had last week, and broke to a new low, and actually held that bottom though on Friday, because again, that rally back at the end of the day on Friday kept us at that bottom. So we haven't actually violated that low yet. Now, if we violate that low next week, we will have completed that same type of topping process that we had back in 2008. Now, why am I telling you this? The reason I'm telling you that is because back in 2008, that was your signal that you were in a recession. And the other thing that tells you you're in a recession is when money starts rotating out of equities into bonds, which we saw this week. So you have two real key indicators that you're likely in a recession. Now, layer on top of this, the reports that we got out of Walmart and Target this week, absolute devastation, and not just Walmart, Target, but there was the Ross stores and just about every other retailer. Terrible reports, all about two things in particular. And it's something that Adam and I talked about 10 shows ago now, that two things were going to happen. One is that the inflation that we have is driven by all the liquidity that we stuck into the market and no supply. And that's what caused the inflation. We had people running out to buy stuff and there was no supply to meet it. So prices went through the roof. That's why we have inflation. What Walmart, Ross, Target all told you this week is A, sales are slowing down, and B, we've got too much damn inventory. And that's the problem, because now they've got to start working off that inventory build, which means that in order to get rid of that inventory, they have to do one of two things: cut prices and order less from their producers. So now you have to start looking through the whole distribution cycle of the consumer staple sector and go, well, where does Walmart get its products from? Well, they buy Oreos from Mondelez, right? That's in the store. So if they're going to order less Oreos, that means I want to be careful about what Mondelez's reports are going to look like. If they have Nike shoes in their store, I want to go take a look at what's going on with Nike, right? Go right on down the list. Everything they sell at Walmart, go look at that supplier, because they're going to be ordering less. And here's something I didn't really, I knew this was the case, but it didn't really dawn on me until I did the research this week. Walmart is twice the size of Amazon in terms of sales. And, that kind of baffles me, because everybody orders from Amazon now, right? It's like, who shops at Walmart? Everybody gets from Amazon. But when you're talking about a bellwether for the consumer, Walmart, Amazon, and Target are all telling you the same thing. The consumer's slowing down. We got too much inventory. Prices are going to come down, which means we're going to see more disinflationary pressures later this year. And what Walmart, Target, Amazon, Ross are all telling you is that we're probably in a recession. And that's what stocks are telling you. And that's what bonds are telling you now as well.
All right, that's great. One other data point that came out of the Walmart report there, and I think I saw the same thing at Target too, was that they had said that they had sort of overhired, meaning they both said we kind of have almost too many employees right now, right? And you and I went on our rant last week about jobs market and how we don't really believe those numbers, and how we think we may go from a jobs glut to a jobs drought faster than most people realize. But I think this was an important validation that, hey, that we may very well be heading to that destination soon.
Interestingly enough, the job openings turned down this week. So we're starting to already see maybe the peak there. And look, corporations are slow to hire, slow to fire. And, so right now, and for the probably next couple of months, we're not going to see all this in the employment reports. Employment reports will probably, kind of stagnate here a bit, but you're not going to see anything, drastic. Corporations are very slow to hire because they want to make sure before they start hiring things that the economy is doing good. And they really kind of bamboozled themselves. They had all this liquidity coming in. They're getting swamped with demand. So they started hiring up, made the mistake of thinking that was organic growth. And, it was clear it wasn't, but they ramped up for it anyway. But now you've got all these good employees, and I just spent a whole bunch of money training all these people how to use the POS and how to stock shelves or whatever my business is. Now I've invested all this money in these employees. The last thing I want to do is go fire them, because if this is just a little short-term blip in the economy and the economy comes roaring back again, I've got to go and hire more people and spend more money to train them. So, corporations are real slow to fire. But if this thing begins to drag out more and we see a bigger downturn economically, we're going to see a very sharp increase in jobless claims and a drop in employment, because companies will start to lay off employees to protect profit margins, particularly because they ramped up wages so much to hire them. Then the higher wage employees are going to be the first ones to get fired.
Right. Yeah, exactly. All right. Well, I do want to note real quickly, I just finished an interview with Wolf Richter. I'll put up a link to it here for folks that want to check it out, because we do talk a bit about recession. And just so you know, Wolf agrees with us. He thinks we're headed to recession. Where he disagrees is looking at the consumer data. And he says, hey, look, we're going to get there. I think it's just going to take maybe a couple quarters longer than people are beginning to, expecting right now, because you're seeing recession a lot now, in the headlines. And what he says is we are seeing now consumer goods demand beginning to roll over here. We just gave a couple of great examples of that. Yep. He said services have not yet come down yet, and actually they're still rising. And this is multifactorial, but two of the big ones, he says, hey, look, we pushed a ton of liquidity out into the world. There is this pig through the python process, and the pig isn't all the way through the python yet, right? So there still is, excess liquidity, out there that's being spent right now. You also have a bit of the opening up, element still, where, most states or all states have pretty much, given up their lockdowns and the masks have come off and stuff like that. And there's a lot of pent up demand out there for things like elective medical procedures, or people that just want to travel now. They don't really care anymore. I got to get out of the house. I've been locked in for 2 years. So we're seeing that on the services side here. And so I'm just flagging this because I agree with you. And I'm more on the pessimistic side of our odds here. I'll take the under on when the recession arrives, but I always think it's good to keep your eye on the data and listen to experts like that who comb through it all. So, so this may not be as cut and dry as many people may be assuming right now.
No, absolutely. Look, the whole thing with trying to predict a recession is always the timing. And when I'm saying that we're either about to be in or we're in a recession, we really won't know for a while. And this is a point that I'm making in the newsletter this weekend, is that if you wait for the National Bureau of Economic Research to date the recession, it'll be over. Generally, the dating of the entire recession comes at the end of the recession, not at the beginning of the recession. So, Wolf may be absolutely right. And he's absolutely right about the services side. I'm taking a look, and if you take a look at a lot of the manufacturing data, we're rapidly running towards a recession in manufacturing data. So we could see a manufacturing recession start early. That's going to feed over into the services side. And this thing may take a while to, it could take a quarter or two to play out. And that wouldn't be surprising at all, because again, dating one is really the tough part, because we're all working with lagging data. And he's right about kind of pushing this through the pipeline. So again, but again, watch companies like Grubhub that's a great company to watch for a recession indicator, because if all of a sudden they report a sharp drop in orders, that's going to tell you what the consumer's doing on the service side. I mean, because Grubhub was talking about during the whole big pandemic run, when everything was going on, they were getting like 3,000 orders a minute or something, some crazy number of just orders being placed at Grubhub. So, those are things you can watch for real time, that when they start reporting weaker order numbers, you're probably going to know that the service side is starting to break down.
That's a great canary in the coal mine to keep our eye on. All right. So I get your alerts. I've signed up for the real estate, the real investment advice alerts whenever you guys make a new trade.
Mm-hmm.
It tells me right away, and anybody can sign up for that. Actually, where should they go to sign up for that?
Simplevisor.com.
Simplevisor.com. Okay. And I actually remind me later on, I got a Simple Advisor question for you that I'd like to ask on behalf of the viewers.
Okay.
But I see that you're now beginning to buy gold. And gold had a decent week. It's been getting sold. It's been getting sold off for a bunch of weeks. It cracked below $1,800 an ounce early this week, which I think had a lot of gold holders a little bit nervous. But it's now sort of fought its way back up to, I don't know, 1840-ish or so here by the end of the week. Can you tell us why you're buying gold right now?
Yeah. So you're absolutely right, Adam. We did buy some gold this week, but we weren't initiating a gold position. We were adding to a gold position. We've talked before about position sizing and how we enter a trade. And gold was already in a pretty good correction mode. We gotten up to around 2,000 on gold and had been correcting. And gold is doing what we call a cup and handle formation, which is a very bullish technical pattern. William O'Neill was famous for talking about this as well. But so we saw gold pulling back, kind of starting to form this cup and handle, and we weren't really sure if we were at the right buy point just yet, because cup and handles can take a while to form out. They've got to kind of form a base and then start to turn back up. So we bought, 2% of our position in gold a month or so ago. And what we were doing this past week is we actually just added to that position. So now we're carrying a 4% weight in gold. And we'll add to that again if we get a breakout of this cup and handle. We'll then add to the rest of the gold position, bring it up to target weight. So that's how we work into a position over time. And that way it allows you, when you're doing this, to try to dollar cost average, bring your cost basis down a bit. Find that your thesis is working. And then if it's not, and the thing breaks down entirely, well, you've only got 2% exposed of your portfolio. So you don't have a lot of risk if something works against you, because again, not everything always works out the way you hope, right? So a good example of that was our spider trade. Didn't work, we sold it, we moved on, and that happens sometimes. But that's why you have stop losses. That's why you manage risk sizing and those type of things, because sometimes things don't work out as you expect. And you work your way through the process. But that's what investing is about. It's not about trying to be right all the time. It's just making your bets and managing that risk accordingly. Because as we were talking about with the casino idea a minute ago, it's how you bet too. If you've got a weak hand, you bet a little bit. If you've got a really strong hand, you bet a lot. And right now, everything's a weak hand. So we're betting little things here and there, trying to pick up things at a discount. Some are working well, some aren't working as well, and that's okay, because overall the portfolio is doing what it's supposed to do, which is it's down, a lot less than the overall market, and that's exactly what's supposed to be happening right now.
Great. And as you said, you're playing to the probabilities.
Yeah, exactly.
All right, thanks for sharing that. I'm sure we have a number of people who watch this program that own gold. I'm sure they're going to take a little bit of heart that you're feeling, good enough about it to basically double your exposure there.
Yeah, but let me say something about this. Gold bothers me because it's not working like it should. You would think, right? So let me just step back. So I'm gonna really make some people mad here. Gold is not.
I don't know. I think you're going to put your finger on their core wound, which is like we're having paradise in terms of the environment for gold. Gold just not responding the way we would.
Well, yeah, and this is the whole point. Gold is not an inflation trade, right? There are long periods in history where it has not performed well with inflation, and I did a article on this a while back. If you go to realinvestmentadvice.com and just in the Google search bar at the top, you type in gold and it'll come up. But what I did, I took a really long chart of gold and I overlaid it to inflation. There's periods where it worked really well with inflation, and there's 20-year periods where it didn't. So gold is a commodity, it's an asset, and we have to treat it that way. But what gold does do really well, it's a fear trade. And when there's a lot of fear in the market, right? The economy's crashing, the world's coming to an end, get your guns, your beanie weenies in your bunker. Gold does really, really well in that environment. And, we were talking a little bit earlier about how there's not a lot of panic in the markets, despite the fact we're, down 20, roughly 20% from the peak this year. And gold's telling you the same thing. There's not a lot of fear, and because gold isn't responding like you think it should. And, but I do think that if we are forming and have formed this topping process, if we are going to get into a recession later this year, whenever it occurs, I think gold will perform well. So I think maybe we're just a little bit early into the gold trade, but once we get into that real kind of recessionary bear market environment, if it comes, I'm not absolutely convinced it's going to happen, but there's a lot of indication that say it will. But if the Fed keeps hiking rates, they keep tightening monetary policy, and we get in and they break something economically, which they will, I think gold will perform well. So that's why we're continuing to build that position. The portfolio is a hedge against our equities.
All right, and hey, I want to note here that the Bloomberg Commodity Spot Index continues to really sort of shoot the moon here. Gold's a commodity. But there's a lot of other different ones in this commodity spot index that Bloomberg tracks here. And the reason why I want to share this is, one, if you have any commentary about the relative strength of commodities versus everything else right now. Yeah. But I also, once you answer, I want to come back to this chart in a few minutes, talking about the potential recession that we're talking about.
Yeah, well, no, there's certainly a lot of commodities that are doing really well right now. Agricultural in particular. Oil prices as well, doing really well. There's a lot of commodities that are starting to show a lot of signs of weakness, right? So lumber prices, copper, have all been showing some signs of weakness. So, again, it's about the weighting in the index and kind of what you're weighted in. The one thing about it, commodities are very volatile, and with the run up in commodity prices, that is also an economic problem. And so, yeah, if you're enjoying, we talked about this before, but if you're enjoying the run up in commodities and you're long commodities right now, don't get hung out there on the moon that this is the way it's going to be for the next 10 years. It's not, because just as we talked about before, high prices cure high prices. And that's particularly the case in commodities. And when we get into a recessionary period, when we get into an economic contraction, when we get into a disinflationary environment, all those commodity runs are going to reverse, because we're going to build supply. That's a function of how economics works. Demand is going to fall, and those commodity prices are going to contract back to normal levels. High prices cure high prices. So just make sure, nothing wrong with being long commodities right now at all, right? It's actually the place to be, but just don't forget to sell, because we're going to rotate in the other direction later this year, next year, whenever it occurs.
Right, and usually when you have sort of extraordinary factors like we have going on right now, that creates these extreme price movements.
Yep.
The corrections tend to happen on somewhat similar timelines as the run-ups, right? So you get these ferocious peaks, but then they cool off real quickly too. So you're given the right warning. And, in that environment, that's where hedging can really play a great role, right? And even something as simple as setting stops, right?
Yep.
Like, hey, I'm just going to protect these gains and I'll ride this thing up as far as it lets me. But if it starts falling back to earth, I get to get out where my stop is, hopefully.
Well, no, that's right. Because, what will happen is with oil prices, it'll happen with corn prices, whatever. You're going to wake up one morning and these things will be down 40%. And you're like, what happened? And you go look at the newspapers like, war is over in Ukraine. And as soon as that headline hits, commodity prices are going to dump because everybody's like, well, what was driving the prices higher is over. I'm getting out now. And remember, the way commodity markets work, it's always the first guy that raises his hand and says, "Mouse like the tulip bubble, I'm out," and then everybody else is out too. And then you're standing there looking around going, well, wait, when's my turn to get out? It's going to be too late at that point. So, be careful. This goes back to investing 101. Don't be greedy. Make some money, take some money off the table, put it in the bank, leave some of your investment online. And again, if you doubled your money in something, take your principal out, right? Play with house money. That way, if it goes to zero, who cares? You just lost house money. You still got your principal. At the end of the day, that's what we're trying to protect is principal. So, don't be greedy, make the trade. It's awesome. But just understand when it reverses, it'll reverse just as fast as it ran up.
Okay. I want to get to my next question, but before I do, are there any other trades you made this week that are worth talking about?
We talked about spiders. We sold those. We went long gold, and we nibbled a little bit, just a smidge in our Costco position, just because that company prints cash. So it's under a lot of pressure right now because of the Walmart and Target. But the big difference between Walmart, Target, and Costco is Costco has a 3% profit margin on all their stuff they sell, but their cash is that $119 a year in a membership that everybody pays every year, period. And that's recession proof.
Right. Because you probably lean into it in a recession. You might be buying maybe less overall, but you're doing more of your buying there, right?
Yeah.
Okay. For folks that perhaps don't know what you mean when you say spiders, can you just give the quick definition?
Yeah, they're little eight-legged creatures that. Spiders are it's actually, if you look it up, SPDR. It's a depository receipt that's issued, and it's basically the S&P 500 index. The trading symbol is SPY. Its nickname in the market, like the NASDAQ 100 index or the triple Qs. The Dow Jones ETF is the diamonds, DIA, and spiders are SPY, which is the S&P 500 index. So that's all we're talking about. We just use it as a trading position.
And it's a common trading vehicle. So if you just want to buy the index, you can just buy the spiders.
Exactly. Very liquid, easy in, easy out, no leverage.
All right, great. So here's the question that I wanted to kind of get to, which is we've talked a lot about, we've mentioned inflation. We've talked a lot about the dangers of recession coming. You kind of munge those two together, you get stagflation, right? You mentioned earlier the term disinflation, where you think things are headed going forward. I agree with you. I think disinflation will probably be the dominant trend for the rest of the year, but I think the debate can be over, what's the rate of that disinflation? How fast is it coming down? And for folks that don't know what disinflation is, it means you still have inflation, but the rate of inflation is decreasing as you go along in time, right? So the inflation is sort of cooling, right?
Right.
I'll give you my personal prediction. You chime in with any differences. I think we are going to have disinflation going forward from here, but I think inflation is going to still run pretty hot. So that rate of disinflation for the rest of the year is not going to be very extreme. We're still going to remain, prices are still going to be pretty elevated as we go through this year. Now, feel free to tell me if you think something different, but my general question for you here is, how do you think about investing in a world of stagflation? When you still have high inflation, but the economy really is slowing down.
So, all right, two things. One, you're correct. And if we assume that every month from now until year end, that we print 0.3% increase, that's a pretty hot inflation print, right? If we're increasing prices by 0.3% every month, that's a pretty fast run rate. 0.3, 10 months, that's 3%, 12 months, that's 3.6% for the year inflation. So We're saying that between now and the end of the year, if we print 0.3% inflation every month through the end of this year, right? That's another 1.8% increase in inflation. But the inflation rate, because we measure it year over year, will drop to 5.5%. So that's still high, right? We're still 3.5% above the target rate of 2%, but definitely lower than the 8% that we're running last month. So it's a function of math and how we do things. It doesn't mean that things are getting any cheaper. As we've said before on the show, if gas is $4 a gallon today and $4 a gallon a year from now, it's still expensive to you, but inflation has now dropped to zero because that's just the way we measure stuff. So, but there's a couple of things that are going to impact inflation more than anything else. If the Fed breaks something and we have a real consumption contraction, inflation is going to fall very quickly. If we're going to have, some type of structure where there's an end to the Ukraine war as an example, and as part of the agreement for ending the Ukraine war, they lift the sanctions on Russia for the exportation of oil. Oil prices come tumbling down. That's going to feed into a disinflationary environment. We could see lower rates of inflation by the end of this year if we get into a real stagnant economic environment. And again, but to your question, how do we invest in stagflation?
Yeah, and I'm sorry, but let me just make sure
Yeah.
I position it even more simply, which
Yes.
is, let's forget about exactly the CPI and, the adjustments and stuff. It's just a period where the economy is contracting faster than today's high prices are coming down.
Correct.
So the consumers are there saying, look, I've got less earning potential, but my dollars are still not buying me anymore. In fact, high prices are just, they're wicked pinching me.
Yeah. Well, and again, so you've got to look at companies that can grow earnings in that type of environment. So this is where you start looking at companies that have very steady earnings growth. You look at companies that can, in other words, you look at companies that people can't live without, right? I mean, I've still got to buy toilet paper. I've still got to buy, hand soap. I've still got to buy these type of things. I've got to buy food. I've got to buy gas. I've got to buy these type of issues. So, utilities should do well. Utilities should do really well because we should see interest rates coming down in that environment as well. Real estate should do well because, again, interest rates will come down. We're likely to have, and again, in an economic recessionary environment, I really like storage because if you get booted out of your apartment or your house, you've got to store your stuff somewhere. So, public storage is a really good area in the real estate market. Commercial real estate, stay as far away from that as you can get. So that's got all kinds of problems. But
all right, but I just want to remind folks who didn't watch last week. I think it was last week where you told us you did add some to a public storage company, right? You've added to your recent, or you made a recent investment in that space.
Yeah, well, actually, we added to a position we've had for a long time in public storage. It's PSA is the symbol. But public storage, PSA, and that stock has had a really big correction over the last 3 weeks. Because again, what's interesting is I've been paying attention to margin debt. We're seeing a lot of investors getting clipped by margin. And the reason that is because all these stocks that were immune to the sell-off earlier this year have gotten monkey hammered over the course of the last 3-4 weeks. And that's because all these safe companies are now having to get liquidated to meet margin calls. And so if they were long Bitcoin on margin and got blown up, they've had to sell all their defensive, I love the stock long-term, Apple, Microsoft, Google have all been under a tremendous amount of pressure. And that's that margin call function working through the system right now.
All right, great. Well, look, here's where I kind of want to wrap things up here a little bit. Well, first, real quick, before we move off the inflation part, the stagflation part, I just want to contrast, Powell's public press conference from 2 weeks ago now, where he made comments like the U.S. economy is still very strong and it's in no way vulnerable to a recession. Well, this week we had Goldman Sachs chair Lloyd Blankfein come out and say that inflation is a, quote, very, very real risk. And we also had recently former Federal Reserve vice chairs Clarida and Quarles both issue basically recession concerns. Yeah. So obviously it seems like Powell is smoking something different than the other leaders of of the financial industry.
Come on, Adam, come on. I mean, the fact that you give any credence to Ben Bernanke is beyond me. This is the guy that in 2008 said, it's a Goldilocks economy. There is no recession risk. Subprime is contained. And we were in the middle of a recession, even though nobody knew it yet because it wasn't announced by the National Bureau of Economic Research until December, that it started the previous December, a year earlier. But right in the middle of all this, Ben Bernanke saying, oh, I don't see a recession. Everything's just fine. And the rest is history. So he has no credence with me whatsoever.
Well, just to be clear, I was talking about Powell, not Bernanke, but I think Powell is playing the Bernanke role right now.
Yeah. Well, Bernanke said the same thing, basically. He's talking about the fact that the Fed needs to act stronger because the economy's fine and they can hike rates faster, all that. But yeah, Powell's the same way. Look, these guys talk a game in order, because again, look, here's the problem. You really can't listen to what Powell says and really any of these other Fed members to any great degree, because what's the Fed actually going to come out and do? Can you imagine what would happen if Jerome Powell came out on TV Monday morning and said, look, guys, we gave it our best shot, but we got nothing.
Right. No, I get it. He can't. I mean, they almost kind of can't. And,
they can't. We would be in a recession by Friday.
Yeah.
So
and just a little background on this. So in my previous life, the company I ran 10 years before this, we interviewed, people across a wide spectrum, not just money related. And we talked to a lot of people who at times were like, sitting congressmen or CEOs of big companies and whatnot. And it was amazing to me how many times we'd have one conversation while the microphone was on. And then as soon as the microphone was off, they'd say, okay, look, here's all the stuff I couldn't say. Right.
Yeah.
And what I think is so, tragic about that is these people are people who the public is looking to give them signals. So these are this is when the average person says, well, it can't be that bad. If it was that bad, I'd be hearing it from, so leader person, right? And the answer is they're deliberately not telling you a lot of the times, right?
Yeah.
So
they can't because again, the markets are so sensitive to every little headline now because of all this automated trading and algorithms and everything else. Literally, if Jerome Powell came out and said, hey, you know what, we're going to be in a terrible recession, nothing I can do about it, we would be in a recession in 15 minutes. The markets would be down 5,000 points. We would be in a recession before the day is out, because that's how sensitive markets are to these headline structures. And they can't say what's really happening. That's why, we spend so much time after every Fed meeting parsing every little line of the Fed statement, parsing every little statement he said. Well, what did he really mean by that? And one of the great, if you ever want entertainment value, go back and read or listen to some of Alan Greenspan's speeches. And he was nicknamed the maestro because this guy could talk for an hour and say absolutely nothing.
And nobody would know what he said exactly.
Yeah. And people walk away and it's like, what the hell did he say? I don't know, but it sounded good.
Right. Well, and there are people are saying that that's sort of one of Powell's, vulnerabilities here. Is he sort of adopted this sort of straight talk regime, which, moves markets a lot more because people know what he's saying, right?
Yeah.
So Lance, I hesitate to ask this question because it just, I can't not ask it based on what you've said, but it really deserves
worms, aren't you?
Well, it deserves its own video here. So okay. I'm not asking you to give your full answer here, just kind of your off the top of the head one, but if the Fed is an entity that can influence markets that drastically, right? I know you were being hyperbolic a bit when you said, like, if the Fed came out and say this, the markets would be down 5,000 points. But they could say things that would send markets into an immediate tailspin like that, right? Should we even have the Federal Reserve? Should we just have some sort of market solution setting interest rates and then just leave it at that? And we wouldn't have the market vulnerable to be pushed to some level where a change of position by some, an arbitrary change of position by a small group of people could have that much impact on the world.
So we're going to do a video on this one by itself.
I think it deserves a full conversation. So I'm not trying to cheat you out of your full answer in the long run.
Right. So right now I'm about to boil over into my rant. So with that, I'm just going to say the answer is no.
No, we should not have a Federal Reserve.
No, we should not have Fed. That's my answer for today. And we'll
Okay.
flesh that out in another video.
All right. And folks, if you'd like to see a deeper dive on that between Lance and I, let us know in the comment section below.
All
right.
And I'm gonna throw stuff at animals and stuff when we're done. So it's all your fault.
Oh, geez. All right. Sorry. All right. Well, look, let's see if we can't get you a little happier by joining me in building on what we talked about in the past couple of weeks here on the outlook for the housing market. We've both said that we're very skeptical of further continued increases in the housing market. In fact, we think there's a fairly large bubble in a lot of key places, and that housing prices are very likely to be headed down from here for a whole variety of factors, paramount of which is just the cost of capital is going up, right? Yep. Mortgage rates have basically doubled in the past year.
Yep.
So I just was searching the headlines on housing before coming on here, and it's pretty amazing. The tenor is radically different from even about a month ago, where it seems every day more and more people are jumping on there's a impending housing correction bandwagon. And there's two headlines I'd just like to mention here. The housing market is looking increasingly vulnerable with a price correction possible, says ING's chief international economist, James Knightley. So we're having more and more, legit economists like this coming out and saying, hey, look, get ready, folks. And then there's this one. One of the world's frothiest housing markets turned into a seller's headache overnight. So they're talking about Canada, and specifically sort of the Toronto, Greater Toronto real estate market. It is one of the most overpriced housing markets in the world when you compare it to both price action as well as the difference between values, home values and underlying incomes. So there's a chart here that I just want to show up for a second here. And you'll see that the city of Toronto is actually in this chart as well. These are showing a number of Ontario cities that saw price declines last month. So we're increasingly seeing reports in the media and in the analysts that follow the housing market that sales are not just slowing, applications are not just beginning to cool, but we're actually beginning to already see price corrections, in some of those most bulletproof markets like Toronto. Yep. So Lance, to me, these are still early indications, but these are really showing, to me that the trouble is really set to brew here in the housing market going forward. What do you think?
Absolutely. And in fact, as soon as I hang up this video, we've got photographers coming to our house to take pictures of it because it is going up for sale as we speak. And we'll be renting for the next 5 years while we wait for the housing market to correct. And then we'll be looking to, buy or build our next house. So, but yeah, this is, it's very fascinating because the prices here in Houston, Texas, as an example, are just, out of control. Houses are sitting on markets for 5 days and getting sold at list price. So, my wife and I were sitting there talking around and we started talking about this on the show a couple of weeks ago. And a good friend of ours is a realtor, and my wife was having drinks with her and she goes, it's crazy what houses are going for. There's a house just like yours that's selling like 2 streets away from you at some ridiculous price. And my wife came home, she goes, we're selling the house. But yeah, and her attitude is right. She goes, we may never get this price for this house ever again, and we can build another house. So that's, she's got the right attitude, right? People get attached to houses. They're an asset. And owning a house is an expense. So that's a different thing. But, you have to look at these things realistically, and these valuations are so out of balance right now because of all this money that was pumped in the system, because of low interest rates, because of what the Fed did. Makes no sense to sit on an asset price that may not get back to even for another decade or more. And our lifespan in this house is not that long because our kids we just had 2 kids graduate high school last night. They're leaving for college. I've got 1 younger child left that can go wherever I am, so it's no big deal. But I mean, that's, and I think that's the thing that a lot of people are starting to think about. And this is and the reason I tell you this is to make this point with you. The big story, which has been a complete fabricated lie all along, has been this housing supply shortage. There is no such thing ever as a housing supply shortage. They may not be building that many houses, right? That's one thing, right? There might be more people that want to buy a house than maybe people that want to sell a house. That's another thing. But there's no supply shortage. And what I mean by that is that housing, what occurs in housing happens on the fringes, right? Of the people that are willing to buy or sell a house. And so up to this point, Adam, are you thinking about selling your house right now?
No, but
Okay.
different story.
Different, that's fine. But you're not involved in this pool of buyers and sellers. You don't exist. So what's driving prices is all these people on the fringes of the housing market that are actively buying and selling a house. That's it. When prices reach a certain point, all of a sudden people get a whole lot more interested in maybe selling their house, right? And if prices begin to peak and decline, all those people that were sitting around thinking about selling their house all of a sudden go, man, I better sell it now because I'm not going to get that price ever again. At least I don't think I will. So I'm going to list this house. All of a sudden, these people come out of the woodworks and list their house. And that's exactly what you're seeing right now. We're already up to 6-7 months worth of supply. And before this is over, we're going to have a housing glut. Everybody's like going, well, what happened to that housing shortage we had? There was never a supply shortage. There's always plenty of supply of houses. It's just a function of price, time, and demand. And once interest rates move to a point, the demand falls, supply hits the market, and you've got a supply glut. And that's what's going to happen here over the next few months.
All right. Wow. Well, look, honest folks, I did not know that Lance had made that big life decision when I asked the question. So Lance, more than anything you could have said, I just think the actions you're taking show the conviction of you know, your assessment of the market. And it sounds like it's, hey, it's overvalued enough that I'm going to get it. I'm going to get the price now if I can, and then position myself to then, you know, be able to buy back in when things are much more sane value wise.
Well, look, and this isn't the first time. I sold my house in 2007. I bought one at the bottom of the market in 2008. So this is how, unfortunately for my wife and kids, I drag them around. Houses for me are 4 walls and the ceiling and an asset price. So you know, they don't get a whole lot to say about where we live.
Well, I mean, the fact that your wife is willing to go along on this with you and not threaten to divorce you over it is already shows.
Actually, honestly, I thought this time I was completely screwed because my wife loves this house. She built it from scratch. It's all her design. She did a wonderful job with the house. I mean, it's just fantastic. And I thought she would die in this house, literally. And for her to come in and say she's wanting to sell the house was like, I literally knocked me off my feet. I was like, okay, we're in.
Yeah, and you're like, all right, let's do it. Well, look, so you did a great job of explaining how housing is priced at the margin. This is something I want to delve into with you more deeply in a future one of these, which is just the importance of the marginal buyer, because I don't think everybody naturally understands that.
That's right.
But you know, as you said, basically, you only need one house on your block to sell for, you know, 20% under yours if the houses are similar to bring the market value of your house down, right?
That's
so
right.
If you think that you're going into a substantial housing market correction, there is a real early mover advantage, which is what you've decided to take, right? And I'm not necessarily recommending everybody to run out and sell their houses tomorrow. It's a very considered decision. Exactly. There are lots of reasons sometimes to stay versus others. But if I take anything from your answer there, Lance, it's that you think substantially lower prices are ahead, substantial enough to motivate you and your family to actually sell your house and become renters for a while.
No, absolutely. You know, it's our view is simply this: is that regardless of what happens, you know, we're going to go rent for 3, 4, however long it is, right? If it's 2 years, it's 2 years. If it's 5 years, it's 5 years. It doesn't matter to us. And, you know, we're happy wherever we live. I love my wife. She loves me. We're best friends. And, you know, the house is a house, right? I mean, it's just where we spend time together. So for us, whether we're renting a house or living in a house that we own is irrelevant. And what we're looking for is our next opportunity will be, you know, our retirement home, our forever home, whatever that's going to be. You know, that's where we are in our stage of life. So in 5, 6, 7 years, wherever that is, you know, when the market's in the right place, we'll go build or buy what we're going to spend the rest of our life in at that point. But that's what works for us. That's not going to work for everybody.
Got it. All right. Well, look, I hate to wrap it up here, Lance. I got a ton of questions now that you've kind of introduced that revelation, but they're going to have to wait.
All right. Next week.
Yeah, next week. Well, folks, thanks for hanging here with us. You know, when Lance and I are talking in these recaps, a lot of the data that Lance is pulling and some of the questions I'm asking him are influenced by the weekly newsletter that he's working on, which launches basically the same day as this video. So if you want to read that newsletter after watching this video, it's chock full of charts and insights and tables and stuff that he and his team have been working on all week. Just go to wealthion.com/Lance. We'll have a copy there for you. We'll also have a link to where you can go sign up to get that newsletter from Lance if you want to get it on a regular basis going forward. Whatever happens from here, Lance will be tracking it together. Folks, if you continue to enjoy these weekly market recaps, I think this is number 20 for us, Lance. Do us a favor, support this channel by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And Lance, whatever happens next week, I look forward to recapping it with you a week from now. Everybody else, thanks so much for watching.